Imagine waking up, rubbing the sleep from your eyes and casually checking your investment portfolio, only to see €1 million staring back at you. For a moment you blink, wondering if it's a glitch. You refresh the page. The number doesn't change, it's real. What would you do next? Would you immediately start planning your dream vacation, call a financial advisor, or sit in stunned silence trying to process how you got here? This moment is the dream of many investors, but reaching it requires a mix of smart financial decisions, patience, and a bit of luck. How would you invest today to make this dream a reality? You built that wealth yourself through smart strategic investing. In this video, I'm going to break down exactly how you can build that portfolio step by step. So let's dive in and unlock the secrets to a 7-figure portfolio. How to build a €1 million investment portfolio, your step-by-step guide. Through smart strategic investing, you made calculated moves, stayed disciplined, and let time and compound interest work in your favor. You remember the late nights spent researching stocks, the tough decisions during market downturns, and the patience it took to let your investments grow. Now the question isn't just how you got here, it's what's next. Do you reinvest and aim for €10 million? Do you start living life on your terms, traveling, giving back, or pursuing passion projects? Now the question isn't just how you got here, it's what's next. Do you reinvest and aim for €10 million? Do you start living life on your terms, traveling, giving back, or pursuing passion projects? In this video, I'm going to break down exactly how you can build that portfolio, step by step. So, let's dive in and unlock the secrets to a 7-figure portfolio. Before we dive into the specifics of building a €1 million investment portfolio, let's take a step back and focus on the mindset and strategy that make it possible. Wealth isn't built overnight, it's the result of smart decisions, consistency, and patience. Whether you're just starting your investment journey or looking to scale your portfolio, understanding the fundamental principles is key. It's like having a destination in mind before you start a road trip. Without a destination, you're just driving around aimlessly, right? The same principle applies to investing. If you don't have specific goals, how will you know which investments are right for you? So, what are your financial goals? Do you want to retire early, buy your dream house, travel the world? Whatever it is, write it down and be specific. Instead of saying, I want to retire early, say, I want to retire by age 50 with €2 million in my portfolio. Now, when it comes to investing, it's crucial to distinguish between short-term and long-term goals. Short-term goals are typically things you want to achieve within the next 1 to 3 years, like buying a new car or going on a vacation. Long-term goals, on the other hand, are those big-picture aspirations that are 5, 10, or even 20 years down the road, like retirement or buying a house. The reason it's important to differentiate between these two is that it directly impacts your investment strategy. Short-term goals often require investments that are less volatile and provide more stability. Long-term goals give you the luxury of time and the ability to ride out market fluctuations. Once you've established your investment goals, the next step is to choose the right investment accounts. This is crucial because the type of account you choose can significantly impact your returns, especially over the long term. Let's start with one of the most powerful investment vehicles available, the 401k. This is an employer-sponsored retirement savings plan that offers some incredible tax advantages. With a 401k, you contribute pre-tax dollars, reducing your taxable income for the year. The money you contribute grows tax-deferred, and you only pay taxes on it when you withdraw it in retirement. Many employers offer a 401k match, where they contribute a percentage of your salary to your 401k based on how much you contribute. If your employer offers a 401k match, contribute at least enough to get the full match. Now let's talk about another powerful investment account, the Roth IRA. Unlike the 401k, contributions to a Roth IRA are made with after-tax dollars. Your money grows tax-free, and when you withdraw it in retirement, you don't pay any taxes on your earnings. Finally, we have brokerage accounts. These accounts offer the most flexibility in terms of investment choices, but they don't come with the same tax advantages as 401ks or Roth IRAs. With a brokerage account, you can buy and sell a wide range of investments including stocks, bonds, mutual funds, ETFs, and more. However, you'll be taxed on any dividends, interest, or capital gains you earn in a brokerage account. Brokerage accounts are a great option for goals that aren't specifically retirement-related. Choosing the right investment accounts is a crucial step in building a $1 million portfolio. Now that we've covered the importance of setting investment goals and choosing the right accounts, let's talk about where to actually put your money. And when it comes to building a solid, long-term investment portfolio, one strategy stands out above the rest: investing in index funds and ETFs. An index fund is a type of mutual fund, or ETF, that aims to track the performance of a specific market index, such as the S&P 500. Instead of trying to pick individual stocks, index funds simply hold all, or a representative sample, of the stocks in a particular index. For example, if you invest in an S&P 500 index fund, you're essentially buying a tiny piece of all 500 companies in the S&P 500. ETFs, or exchange-traded funds, are similar to index funds in that they also track a specific index or basket of assets. However, unlike mutual funds, which are priced once a day, ETFs trade on stock exchanges like individual stocks. Both index funds and ETFs offer investors a number of advantages. First and foremost, they provide instant diversification. By investing in a single index fund or ETF, you're spreading your money across hundreds, even thousands of different stocks or bonds. Second, index funds and ETFs tend to have very low fees compared to actively managed mutual funds. This is because they're not paying a team of analysts to pick stocks. Third, index funds and ETFs are incredibly tax efficient. Because they're not actively trading stocks, they generate far fewer taxable events. Two of the most popular and effective options are the S&P 500 and total market funds. The S&P 500 tracks the performance of 500 of the largest publicly traded companies in the United States. Total market funds aim to track the performance of the entire stock market, including small cap, mid cap, and large cap stocks. Now let's dive into another powerful investment strategy that can help you build a €1 million portfolio: dividend growth investing. This strategy focuses on investing in companies that have a history of consistently paying and increasing their dividends over time. Dividends are essentially payments made by companies to their shareholders, typically in the form of cash. Think of it as getting paid to own a piece of a company. Dividend growth investing can be a particularly effective strategy for building long-term wealth because it allows you to benefit from both the growth potential of the stock market and the power of compounding. When you invest in a company that pays dividends, you have the option of receiving those dividends as cash or reinvesting them back into the company to buy more shares. Reinvesting your dividends is where the magic of compounding really kicks in. When you reinvest your dividends, you're essentially buying more shares of the company, which means you'll receive even more dividends in the future. Those additional dividends can then be reinvested to buy even more shares, creating a snowball effect. Companies that typically pay dividends are well-established, profitable companies with a track record of consistent earnings growth. Think of companies like Coca-Cola, Johnson & Johnson, or Procter & Gamble. Investing in dividend growth stocks can provide a steady stream of passive income. As you accumulate more shares of dividend-paying companies, the dividends you receive can start to become a significant source of income. Dividend growth investing can help protect your portfolio during market downturns. When the market takes a dip, stock prices tend to fall, but dividends are typically less volatile than stock prices. As we approach the end of our journey to building a €1 million portfolio, there's one final, crucial step we need to cover: reducing fees and taxes. Even small fees and taxes can eat into your returns over time, significantly impacting the growth potential of your portfolio. Let's start with fees. When it comes to investing, fees are everywhere. There are trading fees, management fees, expense ratios, and a whole host of other charges that can chip away at your returns. One of the best ways to minimize fees is to invest in low-cost index funds and ETFs. As I mentioned earlier, index funds and ETFs typically have much lower fees than actively managed mutual funds. Another way to reduce fees is to choose a discount brokerage account. Discount brokerages typically charge lower trading fees and account maintenance fees than traditional full-service brokerages. Now let's talk about taxes. Taxes are an inevitable part of investing, but there are ways to minimize your tax liability and keep more of your hard-earned money. One of the most effective ways to reduce taxes is to invest in tax-advantaged accounts, such as 401(k)s and Roth IRAs. Another tax-saving strategy is to hold your investments for the long term. Short-term capital gains are taxed at your ordinary income tax rate. Long-term capital gains are taxed at a lower rate, typically 0, 15, or 20% depending on your income level. By holding your investments for the long term, you can potentially reduce your tax liability. Finally, consider tax loss harvesting to offset capital gains you may have realized from selling winning investments. So, there you have it. Those are the steps you need to take to build a €1 million investment portfolio. Remember, building wealth takes time, patience, and discipline, but it all starts with taking that first step. Start investing today. Even if you can only afford to invest a small amount each month, the power of compound growth can turn those small, consistent investments into a substantial portfolio over time. The best time to start investing was yesterday. The second best time is now. Drop a in the comments if you're starting your millionaire journey today.